Consumer prices in China increased for a third consecutive month in April, defying predictions of weaker demand. The closely watched numbers follow upbeat imports data for April, suggesting that a series of support measures by Beijing are finally boosting consumer spending. The National Bureau of Statistics said the Consumer Price Index rose 0.3% year-on-year, ticking up from a 0.1% growth in March. That's as price increase in areas such as energy, education and tourism offset a 2.7% fall in food prices. Well, core inflation, excluding volatile food and fuel prices, expanded 0.7% in April. That's up from 0.6% in the previous month. The data is the latest sign of increasing consumer demand in the world's second largest economy, even as a years-long crisis in the real estate sector continues to squeeze households' spending power. However, China's industrial sector is still in negative territory. Producer prices declined by 2.5% last month, marking the 19th consecutive month of drops. The weak PPI reading has now prompted calls for further central government support as it unveiled an ambitious 2024 economic growth target of around 5%. Well, let's get more on this with Hani Abouagla. He's XTB MENA Senior Markets Analyst and joins us live now from Dubai. So, Hani, China's consumer prices rose for a third month in a row. Is it too early to say that deflationary pressures are finished?
Hi, and thank you for having me today. I think, for third month only, with a little increase, 0.3. I think that we are still far from the deflationary. I think because we know that China, they tried a lot with a lot of package to boost the economy inside, and especially the consumer spending. If we know that about 2023, the inflation only increased by 0.2% only. And don't forget that the whole like March and April, the oil price was going up. I think this is a reflect of like an inflation inside, which is not pushed by the consumer spending. It's more pushed by the fuel and other things inside. I think China, I don't think they will end the year with a good inflation with a target of the central bank. I think it's still there is still a way to go for that one.
Okay, a way to go. Chinese Premier Li Qiang announced that ambitious 2024 growth target of around 5%. How realistic do you think that is?
I think that this threshold of 5% in China, we always hear about it, and they always aim for that one. They said that the same thing last year, and they couldn't reach it. They reached 4.6 only. I think this time it's not that easy for them. What we know about the real estate inside, also about the industrial production, this is almost, I think, 50% of the GDP. It's not easy to reform those two sectors and also get out of the crisis. Second thing, I think the market today, after they went down, they went up again because of announcing China this morning. There is a bonds of 20, 30, and 50 years long bonds with around 1 trillion yuan. It's almost $138 billion. I think this is what moved the market up today because they know that again the government pushing the economy and trying to at least push the economy back again, especially after what we hear about from Biden, that they're gonna make another tariff on the electrical cars from 25% almost all the way to the 100%. I think with the two leaders announcing that they will increase the tariffs on China, the consumer, they are not happy about that, and they don't have enough confidence in the Chinese market. I think there's still a long way to go for China. Things will not be clear unless after the US election.
Okay, and over the past couple of weeks, Hani, Beijing has unveiled a series of measures to shore up its indebted property sector. Do you think those measures are enough? And how important does the sector continue to be for the Chinese economy?
I think the debt on this sector is very big. It's not easy to just get rid of it in few months, even in 1 year. I think China at least need 2-3 years to reform this sector and try to boost the industrial sector and also the what you call it, electronics and IT sector, which is they are going more in that one. The chips market, they are trying to increase that one. So at least that one can replace part of the real estate market, which is took almost 25% of the GDP. I think this is a very long way to go. It's not that easy to reform it now. I think the world has to understand that China they have internal things they need to do to boost their growth, and the world shouldn't depend on them that much as before. We know China lead the world for the 20 years in the growth. I think they need to depend on other countries now and leave China to do their work inside.
I know you'll be keeping an eye on that, as will we here on TRT Business. Hani Abuagla, many thanks.
Thank you.
Okay, now let's get a quick look at some of the top business stories around the world. Microsoft has announced a $4.3 billion investment for developing data centers in France. The tech giant's reveal came on the eve of the 7th Choose France Summit, which aims to attract foreign investment into the country. It follows fellow US giant Amazon, which will be spending more than $1.2 billion in the country's tech infrastructure, creating 3,000 jobs. The South Korean government has announced plans for a support package worth more than $7.3 billion for chip investment and research. This strategic move will specifically target chip materials, equipment manufacturers and fabless companies, and it will be a major boost to the semiconductor supply chain. More details of the package are expected in the near future. The US Senate Majority Leader Chuck Schumer is urging the Federal Trade Commission to halt the $53 billion Chevron-Hess merger proposed last October. The deal would grant Chevron a significant foothold in Guyana, one of the world's newest oil producers. If the merger happens, analysts say it could grant the oil industry additional leverage to raise prices. And a US Federal Reserve judge has blocked a new Biden administration rule that would cap fees on late credit card payments at $8 a month. A US district judge granted a preliminary injunction to several business and banking organizations that allege the new rule violates several federal statutes. The law, which would have saved American households $10 billion a year in fees, was set to take effect on Tuesday.